Morning, everybody. Welcome to another study time with Steve. I'm Steve Gormley, the Director of Portfolio Management here for KWB Wealth. I'm joined today by Mike RAZZOUK. He is an Executive Wealth Manager here for the firm, and you get to see all his alphabet soup behind his name today as well. So I got an email today from our our pay provider that said it's your 16th anniversary of working at KWB Wealth. So yeah, so this is my 16th year. I'm gonna have my Sweet 16 party later today. Uh,
Congrats, Steve.
thank you. All right, so let's go ahead and dive in.
We missed your quinceanera last
I
year.
know, right? I should have celebrated again last year. All right, so this is some very important disclosures, and we'll go ahead and get started. So, Mike, why don't you take us away?
Okay, so before we do that, what did you do for Mother's Day, Steve?
What did I do for Mother's Day? We went out to a brewery because that's what Kelsey wanted to do, and there was a lot less people there than anywhere else, like at a brunch restaurant or anything like that.
I heard Mother's Day is actually like in the US, the day with the least amount of crime. So I
Oh,
didn't know that many moms are out committing crimes instead of having brunches with their kids, but
yeah, makes a lot of sense.
go figure. So let's jump in.
There you go, Mike.
All right, so I wanted to start with what creates stock prices. And in the end, it's a combination of corporate earnings multiplied by sentiment. Let's call it that. And so what's been kind of interesting is when you look at the history of stock prices, let's go to the next chart here. When we checked the S&P 500, February 19th, I mean, this is pretty much the peak of the market for 2025. You know, we had 6144 on the S&P, and what that was it was a combination of corporate earnings and sentiment. You know, how were people feeling? Were they feeling good? How much were they paying for those earnings? And so the corporate earnings were about 274 bucks, a multiple of 22.4 times them by each other, you got 6144. And so what the market is trying to do is it's looking at all the future expected earnings of companies, bringing them forward to today, and then we create a stock price. And so I wrote a blog many years ago about this and basically saying markets are expectations. You know, if we deviate from that expectation in a positive way, market goes up. If we fall short of those expectations, the market goes down. And so what's been a little bit interesting about what we just saw in April, let's go to the next slide after this. It started with a fall of multiples, right? You know, corporate earnings came down a little bit, the multiple came down some. And so on May 7th, we had 56.50 as the stock price in the S&P. So I guess what I wanted to kind of chat with you about a little bit, Steve, here is, you know, now what's the roadmap to get back to 6144?
Yeah. It would be a combination of things. So corporate earnings came down over that time frame because people were expecting tariffs to hit pretty hard, right? I think over the last few weeks that has changed. So, now today, even this is May 7th, we're now May 13th. It's a few trading days later,
Yeah.
and we're close to 5,900. And is it people feeling better, or is it the fact that, hey, now that tariffs are coming down, are earnings going to be a little bit better than we expected as we revised earnings lower? So it's one of those things where this is a fluid situation on the earnings and the multiple side of things.
Yeah. It's
I
a
don't, I
good
don't,
one.
yeah, and I don't think I would say it's not a multiple thing at this point. I would say
Yeah.
it's an earnings thing at this point. People are saying, all right, tariffs are coming down. The earnings that we expected might be more true uh, from the beginning of the year than they are today. And so it's one of those where I don't think people are necessarily feeling that much better, but I could be wrong. It's one of those that it's a fluid situation. So
Yeah.
I couldn't tell you.
Because basically that multiple is how much are people willing to pay for those earnings?
Yeah.
Is it 22 times them? Is it 18 times them. And what we saw, basically at the bottom of the market, like April 7th, the sentiment, the expectation just completely plummeted. People felt completely crappy. They were throwing in the towel. Oh, I don't believe these future earnings whatsoever. And so earnings didn't fall initially. It was purely sentiment. I mean, we dropped down to like a multiple of, I think it was 18 times the expected earnings. And now what we've seen is the earnings have come down a little bit and the expectation has gone up again. So I guess the good news is people are starting to feel better.
Yeah.
And I guess, to me, it's like the roadmap back to 6144 would be kind of a combination of, yeah, you get good news with the tariffs, which I don't know, check, you think?
Yeah, we're
So
getting, I mean, we're getting it as it goes on.
Yeah, I think the announcement was really strong. It's tapered back a little bit, and people are starting to see, okay, these likely aren't going to stick in their current form. And so we're seeing lots of revisions, which are increasing people's expectations, and then also increasing the earnings. So I think if we have that, we get a tax plan, and then if you have deregulation, hey, we can get to all-time highs by the end of the year. What do you think?
Yeah, I mean, I definitely think so. The other thing to note, this is the earnings estimate is forward earnings. So it's not the earnings today. The other thing that I'm thinking about is what do second quarter earnings look like? Because first quarter earnings are almost finished now.
Right.
It's
and they were beating, right?
Yeah,
like
they were great. I mean, I think it was
13% growth.
Yeah, 13% growth. I mean, that's pretty outstanding for where we're at in a cycle. But everybody is worried about second quarter earnings. But
Right.
what will happen is as those second quarter earnings come out, the market isn't really looking at those anymore. They're
Yeah.
looking at the estimates for the next, 6 to 12 months.
Right.
And so
and this is where you kind of get the headbutt between quantitative analysis and technical analysis. Quantitative analysis is looking at what does the actual hard data say? Are we seeing contracting GDP numbers? Are we seeing the earnings come down of companies? Where technical analysis is purely looking at momentum. It's looking at predictors using past data and charts. Basically to say, are we having positive momentum or negative momentum? Right. And so the two are kind of butting heads at the moment, it seems like.
Right, and we're going to get to a lot more technical stuff as we move forward in the presentation. But the thing to note about the fundamental data, we had a negative GDP report in the first quarter, but a lot of that was just pulled forward inventory. So all these companies are out there saying, "Hey, we have this potential tariff situation. We're going to bring as much of our inventory into the country as possible now." So there's a lot of spending that goes into that, but it drives the profits in of those companies down. And so it's one of those things where it's a short-term kind of hit to the GDP that should work itself out as time goes on. So the fundamental and technicals are really, like you said, butting heads, and it's a tough situation to start from as allocators. For us,
Right.
it's one of those things where we're working on the assumption that the tariffs that were announced on Liberation Day are the highest they're going to be. They're not going to go any higher than that. And so as everything starts to come down and people start to see, here's what the actual tariff numbers will be, I think a reevaluation of what's going on underneath the surface is warranted. And so, yeah, I definitely think, if most companies were expecting, let's say, 6,750 on the S&P 500 by the end of the year, maybe that comes down slightly, but it still leads us to new highs.
Right.
Yeah.
Yeah, I think it seems like lots of analyst reports are coming in like 6,500, kind of in that. I was just mentioning Mike Wilson from Morgan Stanley, who was like the biggest pessimist in 2022, is at 6,500 with a year-end target. So I think lots of people are feeling better within the last month or so. The expectations came down dramatically, and people are starting to see, okay, maybe the news isn't as bad as we expected initially, and things are getting better. And like I said, I mean, there's definite things that are positive momentum behind the market going higher. I mean, the Fed could lower interest rates more than expected. Corporate earnings have been coming in stronger than expected. I think we just got an inflation report that said we had the lowest inflation growth since 2021. So the interesting thing is people keep on expecting terrible news, and it comes in pretty good. And so, it causes things again to, if we have news that's less bad than expected, the market goes higher. Everything is based on that future expectation, which is very hard to predict. So, that news has been coming in better than expected, and we're happy to see that.
Yeah. Well, let's get into some of that sentiment. So
Yeah.
the next chart is showing how bad sentiment really got during that month of April. And you can see, the percent of people in this survey that were expecting stocks to go down over the next year was close to 50%. And, it's very rare for this survey to get there. You can see it happened in 2008, 2009. And when those spikes happen, it seems to be at bottoms of the market. So one of those things that we look at is sentiment is usually the opposite of what is actually going to happen moving forward. So when you get really poor sentiment, that's typically a good sign for us.
Yeah, and this is startling to me because it shows how bad people reacted to news that didn't even really happen, right? I mean, it was just like everybody felt so crappy, and yet the reality is we haven't even seen any impact on the economy yet. It's probably not going to happen until second quarter earnings and data and whatnot comes out. So, the expectation definitely led the market lower, that multiple contraction that we talked about. And, I think that we've kind of seen a big flip in the last couple of weeks here on that again.
Right.
But yeah, I mean, when you get that level of pessimism, I mean, the last time we had that was 2008 when you looked at that chart. I mean,
right.
So it's like people thought that the world was going to end and fall off a cliff, over tariff announcements. So yeah, it was definitely a big reaction.
Yeah.
So what's some of the positive
so
that we see kind of developing from here?
Yeah, since that bottom, we have seen a lot of positive momentum for the market. So I'm going to go through a few of these slides. I'm going to go pretty quickly through them because they're all kind of pointing in the same direction and saying the same thing. And Mike was talking earlier about kind of technical analysis and maybe trying to extrapolate things that have happened in the past to predict or to kind of see where the future might go. So this chart is showing 2 days that we had over 90% of stocks that were advancing during those days. And so when that happens twice in a 9-day period, it's only happened, four times. But every single time, it's been a very big positive for the market. So you can see the 12-month return after you get that signal is in the 30s. So really positive from those when you see that type of number. So let me go to the next one just because I'm gonna go through some of these pretty quickly. So the next one, same thing, past 2 weeks, and I think this came out on April 23rd, so right after that other chart. When we've seen more than 70% advancers on the New York Stock Exchange 6 out of 10 days. And again, really great returns as you move forward. And I love there at the bottom, you can see what the return in all years since 1950. So, our average year is about 9.2 in the 9 to 10 range. And an average after you get this signal, again, in the 20 range.
Yeah, so it's like a 12% difference.
Right, exactly. So really big difference. And even the 6 month. 6 month is a huge rip higher compared to a normal 6 months. All right, so another one, Zweig breath thrust. So the first study time we ever did, there was a signal that triggered right after that in 2023. And so you can see we got that trigger in March of 2023. And from there, market was up 26.8% a year later. There was another incidence of it in November of that same year, and it was up 32.7 from that low. So just one of those things. Another one that comes out. We saw this happen on the 23rd as well. And
just to explain it, I mean, basically, it means that if you look at stocks that it's a momentum trade essentially. When stocks are going down, This is looking at their 10-day moving average. And so if we go from 40% to 61% that are advancing, and that's stocks within an index, in this case, the S&P 500, it's a really positive sign. It means that the momentum has shifted from being overly negative now to very positive. And so when that happens again in a 10-day period, historically, it's been a pretty positive sign for the markets. And, the future returns have been extremely positive.
And the other thing to note, and I love when there's more evidence of it, when it's happened more times. So you saw on the first chart, it had only happened 4 times. The second chart, I think it was closer to 7 or 8. This chart, it's happened quite a few times. And every single 6 month period is higher. Every single 1 year period is higher. So it's one of those that the more signals of a certain thing that you get, the more predictive it can be as you move forward. All right, the next one, another S&P returns after recovering 50% of the bear market. So we went down. I mean, I love the semantics of how this works. We
Right.
went down, I think, yeah, 18.9%
On a close,
on a
right?
close,
We
right?
closed
On a
18.
close. Intraday, we were down more than 20%. You can see that this has happened a few different times. The most recent one that I remember is 2018. We were down 19.4 or 19.8, and intraday we were definitely in a bear market, but we don't call it a bear market because we were never down 20% on the close.
Didn't close. Yeah.
I love how we can twist ourselves in knots to make things look weird. In any case, so again, looking out 12 months, so we went down 18.9%. We've recovered more than 50% of that low off the bottom, and 12 months from that signal, you see another, an 18% average return after that. And again, a lot of signals showing this. Now, the other thing to note on this chart is there are a lot of instances where you might retest that bottom over the next 1, 3, 6 months. So what we're trying to say today is there may be some more volatility as we move forward, but in the long run, if you look out a year, you're probably in a good place to be investing.
Right. And I think when you start looking at all these signals combined, right? I mean,
Yeah,
we've got like 4 of these charts in a row. You had 22%, you had 30 something percent, 18%. I mean, the 12 months from these signals is usually 20, 25% on average if you kind of add them all up. So
right.
definitely some positive news. So
Yeah.
let me ask you this. Everybody's still kind of putting the yard word out there for a potential. Do you feel like the only recession on the horizon is our hairlines, Steve?
That's been happening for a long time, so not a not a new thing. But to me, again, I just come back to the way I think about it is where we reached, where we went down was the worst. That was the market feeling the worst. They said, these tariffs are going to stay in place and it's going to be this number forever. That's what the market was saying. So all of this recovery, everything that's happened since, and every announcement that happens subsequent to today should make the market feel better, right? And so I
Right.
think that's the reason you see charts like this is because there's always that bottom of people feeling the worst, and then where do you recover from that?
And the market is a forward predictor of the
Yeah,
economy. It's
right,
not it's not pricing in the current state of market of corporate returns and earning expectations. It's looking into the future. And so sometimes, the volatility that we have is the market expecting the second quarter or the third quarter data to be bad. And so when we actually get there, and if it is bad, maybe the market's already looking to 2026 earnings or even further out. So just because the economy in the short term may get a little bit worse before it gets better, doesn't mean that the market is going to go back down.
well, and the best thing about recessions is that they don't call them when they're actually happening.
Yeah,
They
it's
call
like
them a
two
year or
years
two
later
later.
sometimes.
So,
Yeah,
we could feel like we're in a recession and go back to 2022. 100% of economists were expecting a recession. We were saying no, there's no real evidence that anything is slowing down. Yes, we had a bear market in 2022. It was a
right.
really tough time frame for putting money to work, But as you look forward to 23 and 24, man, did the market do well? And we never saw a recession. So it's one of those things where the market likes to predict recessions, and not always is it right.
Yeah, I think our biggest case has still just been the unemployment rate. When you got unemployment that's still at 4%, people who have jobs tend to do what? Spend money.
Yeah.
And usually when you're spending money, you have earnings expansion.
Yeah.
So I think still is the strongest predictor. And so, we're wise enough to know that you don't want to see a slow rise in unemployment, because usually slow turns into very quick. It tends to be a cascading effect. But so far, so good. The unemployment rate has actually been coming down. We've been adding more jobs than people had expected. And, again, so far the economic news is consistently surprised to be better. People thought that, hey, with Doge, with government cuts, all that, the unemployment numbers were going to fall off a cliff. And then, last report, we added 220,000 jobs. So, so far things have been coming in better than expected. So yeah, I think at this point, it's still hard to see a real definition of recession. I say real definition because it's possible we'll see one more quarter of contraction. When you look at the first quarter, everything was good except imports, right? And imports like fell off a cliff by 3%. I mean, it wasn't that big of a drop, but it was enough to cause that first quarter of GDP contraction. Yeah. And it's very possible we might see a second, but if we follow the same definition that the economists applied in 2022, where it has to be broad, it's not just 2 quarters of contraction. It has to be, unemployment and lots of companies, adjusting expectations down. Like, it has to be widespread. I think that we're not going to see that personally.
Yeah.
So I think KWB's case still is we don't expect a recession in 2025.
Yeah. Yeah. I mean, the biggest thing for me is right now, what I'm thinking about is I really think the Fed needs to lower rates. The evidence is not pointing to anything on the inflation front. I know that they're worried about tariffs, but as we get more and more announcements, that should become less and less of a worry. And we are seeing a slowdown of employment, but nothing that jumps out to me as something that's worrisome. However, there's other things going on that I think need to be fixed with rates, housing for one in particular. And I just think we need to get ahead of the curve instead of always being behind the curve. And they've proven out too many times that they are behind the curve when it comes to this kind of stuff. And I'd rather them just do a little bit of easing here in the next couple months. So we'll see how that all shakes out.
Yeah, I think it was a little obvious the Fed wasn't going to lower interest rates for May.
Yeah.
I think the market at this point is expecting like a June and August cut, and 3 total by year end, I think, is the expectation. So we'll see. I mean, I hope that the Fed is looking at reports like what just came out with inflation and saying, oh, okay, so far things are okay. But at the same time, I mean, the difficult position that the Fed is in is like, well, if you cut rates, do people then think, oh, there's a problem, they're cutting rates? Yeah. Or do they cut rates proactively because they're already in a restrictive environment? When inflation is less than the actual Fed fund rates, we're in restrictive territory.
Yeah, for sure. All right. Thank you, everyone, once again for attending study time. If you have any questions for your advisor or anybody here in the office, please give us a call. If you know anybody who you think needs help, wants to talk about their risk, talk about their portfolio with an advisor, please send them our way. We're always looking to help clients that want to invest for the long term.